You've heard the phrase a lot recently about alternative facts, but can you invest in an alternative reality? 2016 was a year to forget for equity investors. The FTSE JSE to return what, 2.6%? Offshore returns were even poorer courtesy of a stronger rand. The MSCI World Index was down in rand terms, 4.6%. But one of the interesting things to come out of last year was the fact that the performance of equity products offering alternative exposures did rather well. This is the MoneyMakers. I'm Bruce Whitfield. Tonight we discuss investing in an alternative reality with only one set of facts by closely looking at trackers like CoreShares Divitrax Satrix Rafi 40. Both returned double-digit growth. I'm joined by McMillan from Investec Financial Products. There is an alternative universe to just watching the top 40 index, Brian.
Sure, and we've seen, as you say, the numbers there. Those are really ETFs that are doing what is now called smart beta, so they're taking indices and trying to shape them. You know, it's a little unfair on the top 40 for the last 2 years, flat over the last 2 years or 2.5 years, because within that there's been sectors that have performed very well and sectors that have performed poorly, and they've kind of pulled the top 40, two different ways, and we've ended up flat.
I mean, if you'd gone 2015 and you'd gone long in the top 40, you would have done very well as the currency depreciated off the likes of British American Tobacco. SAB Miller deal would have been in there. Sure. You would have done really well those, and resources would have killed you. And then last year, as the currency strengthened, you were killed on Richemont, you were killed on British American Tobacco.
Sure.
At AB InBev. Resources rescued you on that particular front.
Yes, and that's why we've kind of ended flat. So, that's one of the pitfalls of investing in index investing, and theoretically active managers should do very well in those kind of situations relative. What we haven't seen is that actually happening. So, we saw active managers basically following the market, and again the top 40 is a little unfair because it has that high weight to Naspers now. And it has that high rand hedge component. But certainly on an international scale, where you're looking at equity investing, and certainly the South African investor who doesn't have the ability to go and pick individual stocks in other markets, we believe should really be using things like index investing, the S&P 500.
But how do you get, you call it beta, I mean in English we'd call it outperformance. How do you get beta in the index world?
Well, beta is the index itself. Alpha is the magic one.
I beg your pardon.
Yes.
I'm never being much good at Greek.
And that's the big word. Is there such a thing as alpha even? Many investors, active asset managers over the last 10, 15 years haven't really been able to provide much of that after their fees. In fact, Warren Buffett's got a bet that ends at the end of this year, which he's winning hands down, which is to say that the S&P 500 will outperform a bunch of active managers after fees. And, over a 10-year period, he's well up. So really it's become there has become this big talk of whether you go passive or whether you go active. And what we're trying to do, within the financial products that we do is try and provide access to those markets for investors. So into foreign markets where it's very difficult to go across and say, I'm going to buy Apple, I'm going to buy Alphabet, I'm going to buy Amazon. How do you actually do that? And we like to put together ideas where you can actually do that, but do it on the JSE.
Past performance is no indicator of future performance. We accept that. Okay, fine. See, I've listened to financial services ads long enough to know that. But there was a great story on Bloomberg just last week in which it said, over the last 100 years, the JSE has been the best performing stock market. Now, I'm not 100% sure about that. Certainly the JSE, according to Morningstar, in dollar terms over the last 100 years, is one of the top three. In that top three, Australia, the United States, and South Africa. It's a pretty close run thing. It's counterintuitive that South Africa, over a 100-year period, is such a stellar performer. And maybe we've run out of runway. But why get complicated and fancy with investments if the last 100 years have delivered one of the top 3 performances worldwide for a century?
And Bruce, even if it is the top 3 or 4 or 1, it's certainly up there. And I've seen it in my lifetime. The JSE Top 40 Index in my working life has continually grown over the years. Sure, we've had a pause for the last year or two, But what that is saying is that you have to be invested in equities.
Yeah.
You have to be invested for the long term in equities. And, we really advocate that. And we say, even if the markets are very high, you think personally the market seems very high at the moment, well then, invest in the market and maybe have some protection for the downside. But the major thing is to be invested in that market.
But you're not answering the question. It was very neatly dodged. But why make it complicated and go global when history teaches us that South Africa has outperformed most of the world over 100 years?
Well, when you say why make it complicated, and we're not. We're saying, buy the indices, buy the ETF type trackers, and maybe put on something like a bit of protection if you feel it's too high, or maybe even buy gearing.
Do we need to globalize? And I ask this because most of the top 40 earns most of its money outside of South Africa, or certainly it gets dollar revenues, whether you're talking about, are there any gold shares left in the top 40? I think Goldfields is back in there,
yes,
it was briefly. But certainly they either make dollar revenues or they're based in Europe. For example, Steinhoff is in there, ShopRite is making buckets of money all over the continent. Richemont, Naspers, for goodness sake, is making most of its money in China. Why worry about what Apple is doing and Nike is doing, unless you're a particularly pedantic market follower and you want to have some of those fancy American shoes and fancy American cell phones?
Well, we all use those fancy American cell phones. We all have those shoes. So we're a part of the global economy, and for the South African index that might have one stock, Naspers, that is really an information technology stock or one of these new type stocks. Many people would say that's just only one of them. Why have only one when you can have, a diversified one? And we saw it a few years ago with BlackBerry. BlackBerry was everything. I'm sure you had one. I'm sure you don't have one anymore.
I had one briefly. I love the Nokia 3310, and it's coming back.
I see so.
Which is most exciting. But the world is an increasingly uncertain place. One looks at valuations in the United States, and Warren Buffett may very well be right. But we talk about political uncertainty in South Africa. The United States has got it in bucket loads. They've also got interest rate uncertainty in the United States, and growth uncertainty in the United States. Where do we go for comfort, safety and growth, if that's not a contradiction, in the ETF space as a South African investor?
Sure. I think what it comes down to, as you said, there's three markets. Ourselves, the Johannesburg Stock Exchange, the US market, and you mentioned the Australian market, I think, is also one of those top threes. And we're saying, why not diversify yourself? You don't necessarily have to have, it's very unnatural to have all your investments in one country. South Africa is less than 1% of the global economy.
What we did learn in the finance minister's budget speech, for those of us who were paying attention, was there are only 103,000 people in South Africa who earn more than R1.5 million a year. Those are the people you're talking to right now. For the rest of us schmucks, do we have the capacity to diversify? How do we diversify?
Well, I think we're talking actually not those 1,500 people at all, because
103,000 who got 1.5 million.
Yeah. So those people would probably have actively managed portfolios. We're looking at the people who have from tax-free savings, from 30,000 Rand up to, R500,000 to invest. And for them, it is almost impossible to diversify without using ETFs. Yep. So certainly that's where they could come in.
And it's about cost effectiveness, because the cost of investing, especially if you're trying to get money offshore, is what destroys the value of portfolios after 20 or 30 years.
Absolutely. And as you say, over the long term. So we want to encourage people to be in the market for as long as possible. And the ease of use of some of these products, some of these ETFs or capital protected products, is the major selling point for people that can get in from a small amount.
Traditionally, those of us who understand financial products from 10 and 20 years ago, any capital protection costs you more than half an arm. It's traditionally very expensive. Is it much cheaper now?
Certainly it is much cheaper. I think I think there was definitely a period in time when things were perceived to be more expensive, and certainly there wasn't transparency around fees, that sort of thing.
Is there enough
Certainly,
transparency around fees now?
Absolutely, I would say, purely because of competition. Ourselves, all the major banks now produce these types of products. A lot of them are listed on the JSE. That means you get daily pricing. Liquidity has increased in them. You get daily liquidity, whereas 10, 15 years ago you weren't getting that kind of thing.
It's becoming quite a competitive space as well, and more banks. I know Standard Bank, for example, has recently got Stanlib to build a whole bunch of products for it. They call it the Gold range, or Gold Scorer, or Gold Protector, or something. And they've got a whole range of products like that. They put their own brand on it, gives them something to sell. This is a salesman's world in terms of selling investment products. Sure. It's quite competitive.
Certainly, they have to be sold, and these types of financial products are products that are sold, or have been certainly to this point. But the fact that there are more and more of them in the market, and that they offer more choice to people, has meant that prices have come down, liquidity's increased, and you can get into these types of products with a level of capital protection that kind of opens it up to people who would never have invested before in markets.
But how do those people begin the process? Because unless you've got a PhD, it feels like, to make comparisons between financial services providers, financial products, and understanding really what is at play within these products, it's pretty scientific stuff.
Sure, and Bruce, I know ourselves and all the other banks have done quite a lot of education in the market. These products started off 20, 30 years ago purely in the institutional space, and what's happened to them is over time they've become more and more retail focused. We spend a lot of time with financial advisors, with stockbrokers, going through this. So, most stockbrokers and financial advisors now, over the last 10 years, have really got up to speed on these kind of things. And again, it's really about opening up this to that space where traditionally people wouldn't have been invested in markets or in stock markets because they were too scared. They're scared of losing money. If they get a level of protection on the downside, it makes them feel more comfortable to put money into these things.
Brian McMillan, thank you very much indeed. Brian McMillan is from Investec. There'll be more issues around alternative and other interesting realities about investing. Of course, broadening your views on the world of investments. And can you believe it? Yep, South Africa is certainly one of the top 3 places in the world to invest for the last 100 years. But past performance is no guarantee of future success. Good night and have a good evening. Bye-bye.